with intros from our six panelists on what your organization does, please.
Yeah, thank you to the SEC for the opportunity to participate. I'm Valerie Beauregard, a market structure analyst at Rosenblatt Securities, a boutique and institutional broker and investment bank. As a broker, Rosenblatt represents its clients on an agency basis. We do not own or operate any trading venues or trade for our own accounts, but aim to make sense of our complex equity market structure on behalf of our clients to better serve them in their trading objectives.
Hi, welcome to Texas, everyone. I'm Jeff Brown. I'm with the Texas Stock Exchange. It is a yet to be launched exchange, but we have SEC approval to be an exchange, so that's a big first step. I'm general counsel, I guess I was like the third employee to join the Texas Stock Exchange, and we intend to be a competitor in the listing of American companies, and we think that as Chairman Atkins spoke just a few days ago, maybe 10 days ago, he talked about the importance of IPOs. We agree wholeheartedly with them and intend to drive that make IPOs great again. So thank you.
Hi, I'm Bill Hartz. I'm the CEO of the Long Term Stock Exchange. Thank you for having me, Jamie, and Commissioner Hurst and Chairman Atkins. I think I'd like to maybe try and look at the order protection rule and the things we're talking about through the lens of issuers, which sort of brings a slightly different perspective to some of the things we're talking about, especially in one of the most important functions of a stock exchange to issuers being price discovery, price formation, all which go back to limit orders and their role and the market data behind it and so on. So I'm looking forward to a good discussion on that.
My name is Jaime Llano. I'm the head trader for Teacher Retirement System of Texas. Thank you, Jamie, for the invitation. We represent 2.1 million members. That's a lot of Texas. I'm looking forward for the discussion about the definitions, NBBO, the SIP, all of that.
Hi, thank you, Jamie, and the commissioners, and the University of Austin, which was new to me, for having this. I think it's really, really important to have this type of public discourse when we're talking about big, heady issues like this one and how to change 611. I'm Chuck Mack. I'm Senior Vice President in the NASDAQ's North American Markets Division. NASDAQ is a global financial technology company. We provide solutions and services to institutions, broker-dealers, markets, regulators, investors around the world. In the United States, I think everybody knows we have a large listings franchise where we serve public companies and exchange trade products. And I look forward to this conversation. Thank you.
Hi, everyone. I'll echo Jeff Brown's comments and say welcome to Texas as a resident here since the summer. So glad to see everyone in town. I'm Jeff Starr. I lead operational services for Charles Schwab. That encompasses our order routing and execution businesses. And for the purpose of this discussion, our market data operations as well. We are one of the largest retail broker-dealers in the world, if not the largest. And our motto is through client's eyes, which means we see ourselves as the champion of the individual investor and trader. Should also say we are proud founding members of several exchanges, one of which is the Texas Stock Exchange.
Peggy, take us away.
Okay, great. All right, thank you, everyone. I'm Peggy Sullivan. I'm from the Office of Analytics and Research in the Division of Trading and Markets. Today's panel, we're going to discuss the future of 611 and its implications for the national market system. We'll examine how changes to Rule 611 might impact key rule definitions in Rule 600, like the protected quote and bids. The quality of the NBBO will be discussed.
order execution disclosures, and Rule 605 applicability. Additionally, we'll explore potential effects on equity market data, the revenue allocation formulas, and the fairness of market data access under Rule 603C, which is better known as the vendor display rule, in an evolving market structure. To kick us off, we are going to begin with Rule 600 and defined terms. A lot of Reg NMS substances really sit in the defined terms. And the questions for the panel are as follows. If the commission were to modify or rescind Rule 611, which definitions in Rule 611, if any, would need to be amended or removed? How would changes to Rule 600 definitions affect market data more broadly? And if a definition should be revised rather than deleted, how should the revision be approached? We'd like to begin with Valerie, since Valerie writes a lot on this topic. So I'll turn it over to Valerie.
Thanks again for having me. First, I think when thinking about making changes to Rule 611, the obvious terms that would be impacted are those that involve protection, protected bid and offer, trade through, and intermarket sweep order. If Rule 611 is completely rescinded, I think the SEC can eliminate some of those definitions. But if there's a new concept of protected versus unprotected venues, then some of those terms obviously would still apply, and there need to be further definitions about how protection is determined. However, I also think that there are some terms and concepts that are currently related to protection, but require further thought about how they may relate to the NBBO if protection changes or it's completely rescinded. Take, for instance, the terms automated quotation and automated trading center. Would the SEC want quotes that aren't immediately accessible forming the NBBO? And we also might want to think about marketplaces that don't exist today, but might launch in the absence of quote protection and feature long time delays or other features that make them not immediately accessible. On the one hand, without 611, firms may choose to disregard a quote on the NBBO, but this universal benchmark is still used today in execution quality reports and as a reference price for certain order types. I know that we're diving deeper into the specific topic of the NBBO later on, but I think it's worth highlighting early because once protection is gone, it opens up questions about which venues form the NBBO and if there's certain standards that we'd like them to meet.
Amy?
Yep.
Oh, sorry. I apologize, Jeff. Go ahead.
Okay. Thank you. Valerie, you raise a good point, and you look at some of the definitions and you think, well, this is obvious. In a world without a trade-through rule, do you really need a definition of automated quotes? I mean, if it's a manual quote, I can just trade through it. I don't need to go there. And so you think, well, that's pretty simple. But then, you raise the point about execution quality analysis. What do we do about having manual quotes, in our analysis? Doesn't that bog down? Doesn't that skew our analysis? And you think, well, then maybe we need to keep automated quotes. But is it a matter of latency between the certain quotes that are automated and certain quotes that are manual? And then you get to, call me crazy, the free air of Texas. And as Jamie said, what if an exchange starts in Texas and lo and behold puts its matching engine in Dallas? And now suddenly you're 11 milliseconds away from New York and New Jersey. Do you have to change the definition of automated quote to say, oh, it could only be matching engines in New Jersey, or exchanges could only have their matching engines in New Jersey? That seems absurd. And so you're going to face these types in a new environment. You're going to face these new types of considerations. And so we have to think about what the definitions should be. And definitions shouldn't drive our market structure. Market structure should drive our definitions.
I think the challenge here is trying to future-proof things. I think that perhaps that was what was done with this rule originally, but I think what everyone's talking about is how it is no longer fit for purpose as perfectly as they thought it was when it was originally adopted. Maybe not everyone thought it was perfect at the time, but some people did. And so I think maybe Chair Atkins said this morning, we need to be very deliberate and thoughtful as they make these changes. And I think that's very true. And it applies to kind of every piece, including these definitions. And I like kind of the discussion around automated quotation or automated trading center, what that means. And I think as we shift if we shift to a world without 611, you have to think very hard about what actually really matters. Is it that it's automated, or is it that it's fair and immediately accessible? What are the types of things that we think are necessary for it to make up the NBBO, which the previous panel did a very good job, pretty much in a unified way of establishing that the NBBO is just super, super important, and we would agree with that. So we need to be really, really thoughtful about how and why and if these definitions should change.
Yeah, I would say that this is going to be a work in progress. We're not going to get all the answers on day one or even day 365. We don't really see the need to change anything right now at this point. It could evolve. We could learn some things along the way that would require changing things.
Yeah, as you know, the definitions of in the Rule 600 is the backbone for 611. So this is assuming that we'll get rid of 611. There are many things that will go away. The definition of the NBBO needs to stay. Doesn't have to be the same definition, but some sort of NBBO. And then later on, we're going to talk about why and the quality of the NBBO.
Okay, perhaps we should actually just move in that direction and go directly to the quality and usefulness of the NBBO. So while the NBBO definition itself may not change if Rule 611 is modified, how should the Commission evaluate the broader impact of any amendments, such as removing the access fee cap, which was just previously discussed, on the quality and the usefulness of the NBBO? If effects on the NBBO raise concerns for consolidated market data plans, what considerations should guide the Commission and the SRO's response to those issues under the plans? The questions proposed apply to everyone who is on the panel, and I think we will begin with Chuck.
I think that there's a value to having.
That's fine.
Oh, yeah. I think there's a value to having a standard which we can evaluate against. The question in my mind is the cost and the complexity of putting the NBBO together versus some of the prop feeds that are out in the market that can get us essentially there at a much cheaper cost.
Yeah, I think we've said a lot in the past, the value of liquid and transparent markets. Others on the previous panel also mentioned it. I think most of the time when you think about that, the way it manifests in my mind is the NBBO it's adds this transparency, gives people confidence in the prices they're getting. It is clearly a benchmark for a great many things tied to best execution, which I know they're going to talk about on the next panel. It's related to the SIP revenue allocation. I mean, it is entwined very deeply within our markets, and that just underlines the fact of how important, if you're not going to say NBBO, a relevant price benchmark is when you're trying to implement a trading decision. So when you think about, to me, that's where you start. It's very, very important. People understand that. I think everyone kind of appreciates that having transparency and relevant pricing information's really driven a lot of success in the market and breeds confidence with individuals, whether they're through a mutual fund company like Met or individual do-it-yourselfers. It's valid in the same way either way. When you think about potential elimination or reform of 611 and some of the other changes that would likely go with it, and again, thinking about the previous panel and how deeply they went on some of these topics, and you could go 10 times deeper, there's a lot of interrelated pieces that will need to be thought through. And I'm going to repeat what I said already, the deliberate and thoughtful nature. That's really important as we move forward in this area. But you can imagine a world in which the NBBO that we know it today is very clear what it is. Because of the definitions we were just talking about, you have to be an automated trading center, you have to be immediately available, it has to have fair access, and so on and so forth. So if some of those things start to change, which I expect they would in a non-611 world, you have to think about, okay, what are the things that should make up the NBBO? There is no doubt in my mind that there are many creative and innovative people out in the world. And if 611 goes away and some of these other things change, you're going to see new things that we've never thought about. And you're going to see new things we've never thought about, providing displayed markets out to the world. But they may be different in such a way that they're no longer as deterministic as what we have come to frankly take for granted today. And so you have to really be forward thinking of like, okay, what do we want then in our NBBO? And I think it does tie back to things that are immediately accessible so that they are truly benchmark prices that anyone can access and therefore are a relevant and consistent benchmark for which and reference price for which the market can base all our decisions on.
Yeah, I think that it's crucial to make sure that we maintain the NBBO and the SIP and therefore the NBBO. Otherwise, it's going to complicate our analysis when we do against benchmarks. When you think about what we do, we have 2.1 million members. They're teachers, cafeteria workers, bus drivers. All they're looking for is for a fair and transparent market. And I will argue that the NBBO, a reliable SIP and a reliable NBBO, will do that. It will keep a fair market, a transparent market. And then I'm moving forward with a little bit of the best execution part. It's not only about price, there are other factors like speed, order size, and market conditions. But the NBBO is the first part of that analysis.
I would say, first of all, I think that if you think about removing the order protection rule, and by the way, we don't think it should be modified, it should be either here or gone for all exchanges. When you think about that, it's sort of a let the market decide kind of decision, right? Let the market decide where the best execution can be obtained. And I don't see why we wouldn't also extend that to the access fee caps. If a particular venue is charging too much for a particular stock, then brokers can go elsewhere. Investors can go elsewhere. Let the market decide. So I think maybe we're a little bit, different than other commenters in that we think that access fee caps should be determined by competition. And by the way, LTSE has prices now. We have take fees now. They're less than the access fee cap. So we shouldn't just assume that because there's no cap that everyone would just rise to that. That's not going to happen. Also, I don't think that there's a lot of, I remember when we were first talking about Rule 611 that people were concerned that that a 30 mil cap would distort the NBBO. And it really hasn't. I think where we've arrived at today is a good, robust market structure that incorporates those fees. So in general, I don't think that access fee caps have a particular, would have a negative effect if you let them float. Also, I would agree with Jaime that the NBBO is the bedrock of everything we do. Coming up soon, brokers will begin to disclose execution quality statistics on 605 reports that are all based on the NBBO. If we start making changes now, I think it will lead to incredible confusion amongst investors and users of that data. And so I would urge the commission to hold off on those kinds of changes. Maybe one thing I might do is add odd lots to definition of NBBO, and along those lines, I'll just say one more thing. In about 6 months' time, we're actually going to have a pretty good pilot without being a pilot of what might happen when we have unprotected quotes. And that is that odd lots will begin to be displayed in the SIP, and they will not be protected. And so it's going to be interesting to see exactly what happens. What happens to, will brokers still reach out to take those quotes even though they're not protected? What will happen to price improvement statistics and so on? There's so many permutations of this. So.
Yeah, I could add on to that because I agree with you on the point on access fees in a very broad sense. I took a look at 610 because I had to refresh myself. It's been a while since I read all the FAQs, which, by the way, I pretty much memorized when Reg NMS rolled out, but that's kind of left my brain at this point. But when I was taking a look at this rule, I was like, why? I don't think any of these things really would apply anymore if 611 is removed. I mean, they're all there in support of 611. I agree that if you're going to have a freer market, which I think is the aim of removing 611, it should also be free in these other ways as well. However, having said that, I do think folks on the previous panel did raise some very interesting things that you have to be conscious of, which to me, instead of getting you to the point that means you can't take away these other things, I think much more it tells me that you have to be very methodical in how you roll out this change, which was touched on briefly on the previous panel, but I do think it's important as the commission considers what to change and how to change it. I think they also have to really think through and get lots of public comment and thought on how to actually implement it and roll it out. I think there's ways to do this where you do it in a sequenced manner that's well thought out and not kind of big bang, and you can even do tranches of symbols and maybe even do a pilot. I'm sorry to say that, Jamie, but it's something to consider where you can measure the effects and course correct as you go, which is, I understand, is very tough in this type of situation, but I think it's at least worth strongly considering that implementation plan and how you can do it where you have ways to change or pull back or readjust as time goes.
I agree with Bill and Chuck that allowing the market to determine access fees is the right way to go. However, the points that were raised in the previous panel do ring true to me that when access fee, and I'm sure we'll see access fees at very large levels, and they will begin to dwarf the bid ask, and that becomes a problem because you really need to then show them. The idea of that we heard that showing pre-trade price, pre-trade fee transparency makes sense to me. How else are you going to make a judgment about where you're going to trade if you stumble into a quote that has very high access fees? So I'm a believer that you should free it up, but then if the commission will have to make a judgment about should there be a cap at much higher levels in order to prevent the locked and cross quoting that would ultimately result.
Yeah, I think it just goes back to this important question about which venues, and these could be potentially exchanges and ATSs that are forming the NBBO and those standards. Like the previous panel mentioned, if there's an outlier venue with extremely high access fee and that's feeding into the NBBO, yes, you can ignore it, but ultimately you're using it to evaluate your best X.
One comment on if we want to make sure that we save the NBBO, it seems like everybody agrees, the access fees are a bit trolling, right? A quote that looks great on paper might not be the best quote after fees and rebates. I heard from Professor James Angel from Georgetown. He had the idea of the IBBO on the indicative or EBBO, the effective. This is where we need to start being creative and say, okay, what are the solutions? Because at the end of the day, regardless of any change that we make, from the asset owner, we need to have an NBBO that we can rely on.
Just to tie this back into the definitions, I think one piece of it is that the definitions that currently exist sort of allow for the market data plans to distinguish between automated and non-automated quotes. Would you think that we should be able to preserve that in some fashion, whether it's through retaining definitions or some other means through the plans themselves directly?
Yeah, I think the definition of automated is important when you think about going back to the NBBO and which venues form it.
I think we think about the plans, and I know we're going to get weigh into the revenue formula in a minute, but I do think the definitions are important, and whether it's automated or some other definition, I think you do need to have some clarity with respect to what is relevant. I mean, I think it matters what is a relevant, consistent, dependable price that you can use for all the reasons that folks have mentioned, like Jaime mentioned, using it for benchmarks, for analysis, for the investor when they actually want to implement a trade. That's important, I think, to have some sort of definition in there when you're thinking about how this is going to work with and in concert, the data plans.
Okay, I think we will just touch upon very quickly order execution disclosures, the 605 application. The question for the panel would be, if changes to the NBBO affect order execution disclosures required under Rule 605, how would the commission address these implications? So Jeff from Schwab, would you like to take that?
Yeah, I think we're big proponents of market-wide execution quality statistics that will let evaluations occur between brokers. I think it's as simple as just pointing to what you want that measurement to be against. I think the other thing that we have to acknowledge, though, is while we publish them, researchers often look at the 605 statistics. We've all gone above and beyond in the community to publish additional statistics to try and explain execution quality to retail investors. We don't just turn on our website and point you to a 605 report. We give you detailed explanation of what is price improvement, how do we route orders, how should you think about execution quality. And so I wouldn't anchor on 605 as the only way that retail investors and market participants evaluate execution quality.
Yeah, I mean, that's absolutely right. And when the commission passed, I think it was 11 AC1-5, which is now 605, there was language saying that they expected that data would be sort of a base for brokers to explain more about best execution to their customers, and many brokers like Schwab have done so. But it is important to have uniform measures for that base level of data.
I think one of the problems with the way 605 is constructed and the way firms have to deal with it is that it doesn't really standardize your measurement of execution quality. The different order flow that brokers receive distorts the way their executions will show up in a 605 report. And so for years, Schwab has argued, and I betray myself, I worked at Schwab for 21 years, so I'm familiar with what they did. Okay. But the way you have to understand that these are not going to be like, oh, this report is the be-all, end-all of execution quality. As Jeff said, you have to do much more to demonstrate what you're doing for your client in order to demonstrate your high-quality execution.
Yes, I mean, I think 605 isn't perfect because of the differences in order flow characteristics, but and I also think that there's additional disclosures that are useful to help kind of make sense of them and provide context. But I think overall having this standardized report that's based on this universal benchmark, the NBBO, is helpful to kind of compare and contrast across brokers and across the industry. It's also worth noting that 605 report enhancements are coming next year, along with the additions of OBLATs to the NBBO. So these reports are becoming more comprehensive and more useful.
Yeah, no, 605 reports are super important. But at the end of the day, as asset owner like us, we have TCA providers that will help us improve execution. And this is how we have the communication with the different brokers. And we determine different venues as well. But it's important to remember, and I keep saying the same thing, that NBBO is very important for 605. Let's just be careful not to with the quality of the NBBO.
Okay. Now, let's move on to a favorite topic, equity market data, revenue allocation. The quality of the consolidated data, including the NBBO, is critical to the health of our markets. When the Commission adopted Rule 611, it also implemented a new market data revenue formula among relevant SROs. It essentially allocates half of the revenues to quoting and half of the revenues to trading. Although I do want to apologize to T. Williams for the oversimplification because it is a difficult formula to understand. But some commenters have suggested that the current market data formula for revenue allocation encourages the creation of new exchanges and subsidizes exchanges that quote but rarely trade, providing minimal value to market participants. So the questions are, how well is the market data revenue allocation formula working? Have you seen any unintended consequences from the RAS formula? For example, encouraging new exchanges or many exchanges under the same family. I have two more questions as well. If the Commission were to modify or rescind Rule 611, should the revenue allocation be updated at the same time? And if yes, what changes would you recommend? For example, some have stated that there might be less weight for quoting and more weight on the actual executions, with perhaps a small allocation for the listing markets. I think we should begin with Chuck from NASDAQ, and we'll kick it off.
Yeah, I mean, this is a really important issue. And I think what we're talking about more broadly in the SIP revenue allocation formula as part of this is incentives in the market. I think maybe Commissioner Peirce this morning mentioned we have a situation where there's some misaligned incentives, and we agree with that. And in the broader context, when we're thinking about this, I think we should also be thinking of, we've all well established that we think the NBBO is really important, right? Well, we'll call that the hallmark of the displayed market. At the same time, over the last several years, we have watched the market become darker and darker and more bilateral. And I think that is something we should be paying more attention to. I think that will have, in time, if not already, have significant impact on the NBBO, which we have all just well established how important that is. And so we need to look at incentives across the board and really think through what is the market we need to have for the next 50 years that's going to support the growth of our capital markets, which are, by the way, the envy of the world. When it comes to the SIP formula specifically, like you said, it's 50-50, half quoting, half trading, and it's not a bad formula. I think it's not perfect, and so there's room for pretty significant improvement. And that's, though, based on years of watching and learning. It's not as if whoever came up with that formula made a really bad mistake. It was not quite future-proofed, and that became more obvious over time. And so if you think of the purpose of it, though, the purpose is to drive transparency that supports our market. It's really to drive information in the market for investors and for traders and anyone who's participating in the market in a very transparent way. And so you've got sort of two pieces of the transparency that matter. You've got the pre-trade transparency, I'll call that the quote, and you've got the post-trade transparency, which is the trade information itself, which is price and size. And I think for us, what we think about is what pieces of the market drive transparency most. And from our seat, what we think about it as when you've got the pre-trade transparency combined with the post-trade transparency, that's about as transparent and information rich as you can get. So we've often said things like quotes that lead to trades, but really what we're talking about is a transaction that was tied to a quote at the time of that transaction. And so for us, the way we think about that is we would weight that most heavily. And then I think you've got two other categories that you think about, and that's the quote by itself. And you could argue that because of the issues we've seen, where you've seen quote to trade ratios really through the roof on certain venues that oftentimes add noise to the NBBO rather than adding value, you say, okay, well, we should just take away that incentive for the quote. But actually, that's not right either, because there are securities that do not trade that often where the quote is tremendously valuable. And the most obvious example I think of there is with ETFs and exchange traded products. And a lot of times when they first start, it is very clear what the price should be. And the market makers do a great job providing that price, but there's just not traction yet in that product. But that provides tremendous value to the market in knowing that there is a price and having confidence in that price. That is really, really valuable. And I think things like that are easy to take for granted because we've had it for 10, 20 years. I think on the other side, you've got just the trade by itself. And without sort of quoting activity, I want to be clear here. That could apply to an exchange trade as well. It does not necessarily just mean off exchange, but we would argue that that also has a little bit less value than if you've got a quote and a trade happening together. So if it were us, we design it such that those are the three categories. We weight the middle category, that's a quote and a trade tied together, much more heavily than the other two. The other thing that we've been wondering about and thinking about more recently with the tremendous growth in, I'll call it dark trading, whether on or off exchange, but in off exchange in particular, you have a lot less information in those trades when they go to tape. We operate a smaller market. NASDAQ PSX is one of our two smaller markets, has less than 1% market share. And there are dark pools that are much larger than PSX. But when PSX does a trade, you see the exchange on the tape, very clear where the trade came from. When it's off exchange, you never know. And so as a routing broker, you have to map to all these places. You build heat maps. We do it too with our exchange router, so you kind of know where the liquidity is. So I think as this gets considered, I think one of the things the commission should think about is, do we have the right level of transparency everywhere if the incentive that we want to create is information for the market? And so those are the things I would consider if I were the one kind of piloting or driving the boat for figuring out what the next generation of the SIP formula should look like.
I'm all right. My view, first, the SIP governing committee is powerless to solve its own problems. Because of the unanimity requirement, they've known that there's excessive quoting to trading in certain markets, and they can't change it. And they've asked the SEC through a petition for rulemaking to make that change. And so we're coming back to the SEC having to make these kind of changes. And that's necessary. And it ultimately, and we'll get into it with the vendor display rule, it's a system that may have seen its better days. But far as the allocation formula itself, I agree with Chuck that trades that occur on quotes should get the most credit. I mean, because that is true price discovery. Trades that occur off exchange or hidden orders on exchange that are executed, they're parasitic off of the quote and not necessarily adding to price discovery, except post-trade, which has some value. So they'll get half credit. I think it was Brett this morning who was talking about locked and cross market, trades that occur in a locked market, it may deserve zero credit. I'm not sure, but in trades that occur on a cross market, may have a negative credit. These are things that at least build support for the NBBO itself. And I think that's a fundamental feature. Now, some people argue, and we've heard it this morning, the uncontrolled proliferation of exchanges. Well, the real proliferation of trading is off exchange. And that's a real threat to the lit markets. We have to start thinking about how we're going to, it's been talked about for years and years, but it just continues to grow. And unless exchanges are given the flexibility to compete and to provide traders with the reasons that they're trading off exchange, to provide them with the type of tools that are necessary, you're not going to change that dynamic. It's going to continue to grow. And so I'm a firm believer that exchanges need to be given some, reinterpretation of fair access. You think about what the statute section 65 says that explicitly that exchanges cannot have rules that unfairly discriminate among customers, brokers, and dealers. But Congress put a word in there, unfairly. They didn't say you can't discriminate, and they said you can't unfairly discriminate. So what's fair discrimination? We have some examples. We've got the RLP programs that were approved in the past years, and they, discriminate ostensibly to retail customers, even though it's almost impossible to get retail flow back to the exchanges. And yet, I think that has to be expanded at the SEC. And in essence, fair access needs to be fair to exchanges. And so I'll leave it at that.
I want to talk to something that people have sort of mentioned, that somehow the market data formula is broken. We don't think it's particularly broken. There's always some room for improvement around the edges, but in fact, the market data formula does a pretty good job of weighting different things that happen in our marketplace. And I don't know how many people have actually really taken the time to sit down and look at it. It's very complicated. But in fact, when a quote is at the NBBO for a large notional amount, that receives more credit. Isn't that what we want? We want price discovery. We want more price formation. The market data formula was designed to do that, and it does. So I don't think applying some arbitrary cap to the amount of quotes or quoting that a market can do, I don't think that's useful. And I think as Chuck started to go down this path, I agree with this, which is that you can't always tie a trade to a quote. If LTSE sets the NBBO in a stock and then NASDAQ does a trade, well, then should NASDAQ not get credit for that? I mean, I think that you're trying to draw too fine a distinction there. So we're not convinced that the market data formula needs adjusting at this point. And by the way, if exchanges are making too much money from that, then what they should be doing is sharing it back with their member firms, as LTSE does. We have several price programs that are they're designed to do exactly that. I don't think it's necessary for the SEC to somehow legislate a change in order to accomplish that.
One thing that occurs to me, somebody mentioned earlier about how it's important to have the issuer perspective, and we certainly agree with that. And we've done a pretty extensive research on liquidity in the market and what it means to issuers. And because we know it's important for issuers, we do know that their liquidity in their stock lowers their cost of capital, essentially becomes currency for them. It's really valuable from that perspective. And we have to keep that in mind as well. But what we have always wanted to focus on is ensuring that our issuers and issuers in general have really robust and liquid markets. I think we've been pretty effective at using market quality programs that are driven by rebates and other incentives to provide really high quality markets for our listed issuers. And I will say, it's not directly, but it is certainly part of it. The SIP formula does drive that to some degree as well. So I do think it is really important to look at this deeply. And I would say, kind of going back to the sequencing point that a couple folks have made, I don't think you need to wait for 611 to be changed or repealed in order to make changes to the SIP revenue formula. I would agree with Bill. I don't think it's like this horrendous mess, but there is a significant opportunity to improve it in a way that is going to benefit the markets, the issuers, the investors that are involved. So it's a very worthwhile undertaking.
Okay, thank you. I think that was very fulsome conversation. We've got many different viewpoints. The last point that we have for this particular panel is on the vendor display rule and market functionality. Under today's rules, protected quotes must be honored. In theory, that requirement should encourage competitive quoting, which in turn supports the NBBO and the SIP's usefulness. Since Rule 611 was adopted, the number of exchanges has grown from 7 in 2005 to 21 voting members with 18 active exchanges plus 2 inactive exchanges plus FINRA across 4 groups or families, which is NYSE, NASDAQ, CBOE, and MEMX. And this is just in the current CTA UTP plans, which were just discussed. This growth reflects the shift from the member-owned exchanges to for-profit shareholder entities able to raise capital and expand services such as connectivity and from proprietary market data. So we move into the vendor display rule, which is Rule 603C. Given the current requirement for protected quotes to be honored, how effectively do you believe this rule supports competitive quoting and the NBBO's utility in today's market? And how has the shift from member-owned exchanges to for-profit shareholder entities impacted the number of exchanges and their services? And then I have a second part about the retail customer access. Do retail customers who receive either the SIP or the proprietary type of book feed at the point of sale see the best displayed price available in the market? And what changes, if any, would you recommend to the vendor display rule to ensure that it reflects the current functioning of the market, particularly if the definition of a protected quote is updated? I will begin with Bill Hartz.
Thank you. What's most important is that investors have access to as much information as possible at a reasonable price. I think that we're doing a pretty good job today. Brokers like Schwab provide their investors with great market data tools, and I think we'll continue to see that. I'm not sure that OPR would necessarily affect that, and I'd like to hear what Jeff thinks about it. But
yeah, I think the issue here when we get into the vendor display rule is cost. We obviously want to provide as much data to our clients as possible to let them make the most informed decisions. But the issue that I'm pretty passionate about here is the cost associated with that, because driving the cost down lets us turn around and pass those savings back to our clients. And it gets complicated, but the easiest way that I think about this is a bike. I provide a public utility the pieces for a bike. They assemble the bike and sell it back to me at a price that they set. There's no competitive market forces associated with that price. And I sit there and look at a lot of really nice bikes going around that say NASDAQ Basic, CBO 1 in these prop feeds that do a lot of things that are very, very similar to the bike that I just overpaid for. And so I think that we've got to look at the cost associated with the vendor display rule, because you look at these proprietary products that are out in the marketplace. I mean, most of them are very, very effective. They will even advertise that 99% of the time they're almost right at the NBBO. And so the point in my mind is, well, how do we drive down that cost to get that? Because it's really, really the benefits of having that data versus the cost just is not aligned at the moment.
Jeff, you raise a great point that at the moment of a trade, the vendor display rule requires you to provide the consolidated data feed in order for a client to affect that trade. At Schwab, retail clients are going to trade between the spread 95+% of the time. They know their execution's not going to be on that spread that they see. That is irrelevant numbers to them because their broker-dealer is going to take care of them. And therefore, the idea that you have to buy the SIP feed as well as you have to buy the prop feeds in order to have fastest information you need in order to serve your clients becomes just a redundant system. And so Chuck said that the system isn't a mess. I think it is a mess. I mean, the SEC felt so much so that in 2020, they adopted rules that said, we've got to change this. So we're going to change the governance structure and we're going to change the infrastructure of the data system. And what happened naturally? They got sued by the exchange, and sure enough, the governance piece was thrown out because you know that you weren't allowed to have non-SROs on the SIP governing committee. But the infrastructure piece was approved by the court, and so lo and behold, 6 years later, we're going to get new round lots, and we're going to get odd lots in the quote. Boy, they work fast, let me tell you. And but depth of book in the quote. I mean, depth of book is in the depth of the ocean. You know, it just doesn't happen. And the SEC hasn't said, hey, wait a minute, we adopted these rules. How come they're not being implemented? This is travesty. So I do think what we really have is something that's broken and needs to be wholly rethought.
I don't think I'm going to say anything similar to that, but I just kind of going back to first principles for a second and kind of tying it to the changes we're contemplating. I think the idea behind, hey, an investor should have the relevant information that they need to implement a trading decision is a very good principle. I think what's some people are raising here, and maybe not directly, is what is the relevant information? And the reason I raise it that way is because if you think about 611 going away, and I have every reason to believe that that'll change what displayed quotes look like, because like I said earlier, I think people are very creative and innovative. I think we'll see new things come to light. What is relevant for an investor to make a decision on may become less clear than it is today. And so a lot of thought will have to go into that as well. And I think the vendor display rule is not something I think about that often, but I think it's very interesting to talk about in this context because it raises another point where you think about like, wait, we haven't thought about that in a little bit. How is this going to also, 611 going away? How will that also impact this rule, which is maybe, a little bit, it's on the second panel. So I'll say it's a little bit further down the list of things you think about, but it's really significant and relevant when you start to try and think through how to future-proof any change where there's going to be, an NBBO that potentially has things in it that are a lot different than what we see in it today.
And one more thing, as I said earlier, I think as long as order protection applies or doesn't apply to all exchanges across the board rather than individual exchanges, I think that all the quotes from all the exchanges will be visible through the SIP, which is what investors should have access to.
All right, thank you, everyone. Just to be clear at the end, the SEC only acts through the plans when it's dealing with the specific national market system. It's not necessarily oversight, it's directly through the plans. So I just wanted to make that clear. I appreciate everyone coming and thank you. I don't have any additional questions. Do you, Director Saleh?
No, I think we're good. Mr. Grover?
I'm good. Thank you.
Thank you, Peggy. Thank you, panelists.
Thank you.
Please join us in
Thank you.